there, curious minds. Get ready, because today we're taking a deep dive into a truly pivotal day on Wall Street, July 30th, 2025. It was a day that, well, it began with unexpected optimism, kind of a sun-drenched morning on the trading floors.
Right.
But by the closing bell, the mood had shifted dramatically. Some surprisingly heavy clouds rolled in.
Yeah, it really did change quickly.
You might have seen the headlines screaming about market drops, but we're going to peel back the layers, step by step. We want to understand what really happened, why the sentiment flipped so violently, and maybe most importantly, why it matters deeply to you, as someone navigating the complexities of the modern economy.
What's truly fascinating here, I think, is how the trading session on July 30th didn't just register as, like, another volatile day.
No, it felt bigger.
Exactly. It became a genuine inflection point. It marked a moment where powerful economic crosscurrents, some hidden, some obvious, collided head-on with, well, the resolute stance of the monetary authority, the Fed. So our mission today is to unpack these three powerful, often conflicting forces that converged to shape this single day.
Right.
Start with a Federal Reserve that proved far more hawkish than the market dared to believe.
Okay, the Fed first.
Then we'll dissect some deceptively strong economic data.
Deceptive, interesting.
And finally, we'll examine the escalating global trade tensions that kind of cast a long shadow over everything else.
That's precisely it. We're going to help you shortcut your way to being genuinely well-informed about a day that, well, it genuinely reset expectations for financial markets. Across the board, really.
It really did.
So for us, the learners in the room, the ones eager to connect these dots, what did this all ultimately mean, for how we think about the economy and our investments going forward? This wasn't just a blip. It felt like a fundamental shift.
It absolutely felt like a fundamental shift because, well, it was. The day actually began with a strong sense of almost unqualified optimism.
Right. I remember that morning feeling.
Yeah, early indicators, particularly the Commerce Department's first estimate for Q2 GDP, suggested the U.S. economy had expanded at a robust 3.0% annualized rate.
3%. That's a strong number.
It comfortably beat the consensus forecast, which was around 2.5%.
Okay.
And it represented a dramatic reversal from Q1's 0.5% contraction. So quite a swing.
Huge swing.
On the surface, it really seemed like the economy was roaring back with unexpected vigor. It suggested a, vigorous rebound from earlier softness.
And that initial strength was certainly a significant headline grabber, setting a very positive tone. You could almost feel the relief on the trading floors early on.
Definitely.
But that feeling didn't last, did it? How quickly did that initial optimism give way to something else?
Indeed, that initial strength, despite its impressive headline, it gave way pretty quickly to what we call a risk-off sentiment.
Risk-off.
And this is a crucial concept. It's when investors, sensing trouble or uncertainty, they pull money out of riskier assets like stocks and put it into safer havens, like government bonds.
Got it.
And this shift culminated in a highly divergent closing for the major U.S. indices. That itself is a powerful signal.
Divergent how?
Well, while the broad S&P 500 and the venerable Dow Jones Industrial Average both retreated, and they actually snapped a remarkable record-setting streak of consecutive all-time highs.
Wow. Ended the streak.
Ended the streak. But the tech-heavy NASDAQ composite, quite surprisingly, managed to eke out a marginal gain.
So tech held up.
Yeah, this divergence tells a story. It suggests investors were selectively retreating, not panicking universally, but a fundamental shift was definitely underway.
And the pinpoint catalyst for this dramatic midday shift, it all came down to the Federal Reserve's afternoon policy announcement. Right. And perhaps even more critically, Chair Powell's press conference that followed, right?
Exactly.
The market's interpretation of his commentary was, to put it mildly, decidedly hawkish. It hit like a sudden cold front.
That's absolutely right. There's one overarching lesson from July 30th. It's about a critical psychological recalibration that occurred in the market. A genuine paradigm shift.
Okay, explain that.
Well, for years, the conventional wisdom was kind of good news is good news.
Right. Strong economy, stocks go up.
Exactly. Strong economic data would typically bolster equity prices because it signaled a healthy, growing economy. But that simple paradigm has been definitively supplanted by a more complex and, frankly, cautious reality.
Okay.
On this particular day, robust economic data, that 3.8% GDP number we mentioned, was paradoxically perceived as providing the Fed with the explicit justification
to maintain
its restrictive policy stance. It meant that what would normally be positive economic indicators actually transformed into a significant headwind for risk assets.
So good news became bad news for the market because of the Fed.
Precisely. The pronounced intraday reversal, from those substantial early gains to later losses, it vividly illustrates the market's struggle. It was struggling to price in a central bank that is, for now, unequivocally prioritizing its inflation-fighting credibility over preemptively stimulating an economy that, despite showing some clear signs of deceleration beneath the surface, still maintains an outward appearance of resilience.
It's like the market suddenly realized the bright sunshine of strong GDP meant the Fed felt more comfortable keeping its monetary umbrella open.
Exactly, rather than folding it up and letting the rain of cheap money fall again. That's a good way to put it.
So if we strip everything else away, the Fed's communications were the primary driver of that late-day market downturn. It felt like a giant switch flipped from on to off for risk assets.
Precisely. Investors were forced, quite abruptly actually, to recalibrate their entire expectations for the future path of monetary policy.
Right.
The message from the Federal Reserve was unmistakable. It left very little room for the kind of optimistic speculation about imminent rate cuts that had been, pretty prevalent in the weeks leading up to this meeting.
Yeah, the market was hoping.
It was a stark reality check.
Let's start with the official FOMC statement itself. That came out at 2:00 p.m. Eastern. What was the core message there, and how did the market react just to the initial wording?
So the core information was the widely anticipated decision to maintain the federal funds rate at its current target range. That was 4.25% to 4.50%.
Okay, no surprise there.
Largely priced in, no real surprises. However, the nuance, and this is where, sophisticated investors really parse every single word, was in the language used to describe the economy.
Yeah, the Fed speak.
Exactly. The committee explicitly noted that growth of economic activity moderated in the first half of the year.
Moderated, okay.
And importantly, that inflation remains somewhat elevated. Now, this might seem subtle,
Yeah.
but it was a significant downgrade from previous statements, which had consistently described economic expansion as occurring at a solid pace.
So they took out solid pace and put in moderated.
They did. So while this was a clear acknowledgement of some underlying economic softness, the overarching takeaway from that statement was that the Fed's primary focus remained firmly, resolutely, on fighting inflation.
Right.
It effectively overshadowed any perceived weakness in the broader economy. It's like admitting you have a cough, but, still insisting you're running a marathon.
Gotcha. And then we saw something really rare, a truly divided committee vote, a 9-2 vote to hold rates steady. That revealed a public fissure among the policymakers. That doesn't happen often, does it? Especially that kind of split.
It truly doesn't happen often, and its historical significance, I think, cannot be overstated.
Okay.
The specific details here are crucial. Governors Michelle W. Berman and Christopher J. Waller were the dissenters.
Bowman and Waller.
And they publicly indicated their preference for an immediate 25 basis point rate cut at that very meeting.
Wow, immediate cut.
Immediate cut. Now, to put this into historical context, it marked the first time that two Fed governors, not just regional Fed presidents, right, but actual governors on the board.
Right, the board in Washington.
Exactly, had voted for a rate cut since 1993.
1993. That's over 30 years.
It's a huge span. This isn't just an academic disagreement. It's a very public and I think deeply meaningful split at the very top of the central bank.
Wow. So what are the implications of this kind of open division within the Fed? What does it signal about their future path? Does it make things less predictable?
Absolutely less predictable. This division signals that the internal debate at the Federal Reserve is intensifying dramatically.
Okay.
While the clear majority, led by Chair Powell, is currently prioritizing the risk of persistent inflation, there is a visibly growing faction that is becoming more concerned about the increasing risks of an economic slowdown and, critically, rising unemployment.
The other side of their mandate.
Exactly, the other side of the dual mandate. This split injects a substantial degree of unpredictability into the Fed's future actions. It strongly suggests that the concept of data dependency, which Chair Powell frequently emphasizes.
Right, they always say that.
They always say that. But now it will likely be interpreted through genuinely different analytical lenses by various committee members.
Like different factions reading the same tea leaves differently.
Precisely. Think of it like a jury, where some members are focused intently on the letter of the law regarding inflation, while others are weighing the broader societal impact of a slowdown.
Okay.
Consequently, markets are now almost certainly going to face heightened volatility around future economic data releases and, indeed, all subsequent FOMC meetings.
Makes sense.
Traders are going to be desperately attempting to discern which specific faction within the Fed is gaining influence. This makes forecasting their next move significantly more challenging, and it means the market will be looking for microsignals, everywhere.
And then, the moment everyone on Wall Street was truly holding their breath for, Powell's press conference, starting at 2:30 p.m. Eastern. This felt like the precise moment the market decisively turned negative, didn't it? It wasn't just the statement, it was his tone, his emphasis.
It absolutely was. His remarks were interpreted as decidedly hawkish, and they systematically dismantled the market's prevailing hopes for a near-term policy pivot.
Yeah.
He effectively poured cold water on market pricing, which, prior to the meeting, had implied, a roughly 64–65% probability of a rate cut by the September meeting.
Pretty high odds.
Very high odds priced in. Powell's language was quite explicit. He stated that the Fed is well-positioned to learn more about the likely course of the economy before making any adjustments.
The translation, we're waiting.
Exactly. And he strongly emphasized that the current restrictive policy stance is appropriate to guard against inflation risks.
Okay.
Imagine a high-stakes poker game where the market had bet heavily on a rate cut, and Powell just calmly showed a much stronger hand, effectively saying, not so fast. We're not bluffing on inflation.
Right.
This was an unambiguous signal that a rate cut is not imminent, regardless of what the market was hoping for. He wasn't just holding the line, he was reinforcing it pretty strongly.
He also really hammered home the idea of data dependency, didn't he? And interestingly, he brought in a new wrinkle, tariff uncertainty. That hadn't been like a consistent hacking point before at it.
Indeed. He reiterated that the Fed is not on a preset course and that all future decisions will be guided by the totality of incoming data. That's classic Fed speak.
Right.
But then he specifically highlighted the significant uncertainty surrounding U.S. trade policy and tariffs. This was a notable inclusion.
Yeah, why bring that up specifically?
Well, he acknowledged that their effects on inflation could be short-lived, but he also explicitly mentioned the risk of more persistent inflationary pressures that the Fed would then be obligated to manage.
Ah, so tariffs could boost inflation, making the Fed's job harder.
Exactly. This acknowledgement places a particularly heavy burden on upcoming data releases, especially those directly related to inflation, because the market now knows the Fed is watching these very closely. They're factoring in the potential for tariffs to complicate their mandate. It means they're not just looking at domestic numbers anymore, but also at global trade policy as a direct input to their inflation outlook. It adds another layer of complexity.
And despite some of the underlying economic softness we talked about, the stuff hidden in the GDP report, he still gave a rather solid assessment of the labor market. How does that square with everything else?
He did. Chair Powell described the labor market as unequivocally solid and at or near maximum employment.
Okay.
He noted that while job gains have moderated to a more sustainable pace around 150,000 per month, which is actually a healthy, non-overheating pace.
Right, not too hot, not too cold.
Exactly. But wage growth continues to outpace inflation, which is crucial as it supports the consumer and prevents, a collapse in demand.
Mm-hmm.
This overall positive assessment of the employment situation provided yet another solid pillar of justification for the Fed to hold rates steady and, crucially, to resist the growing calls for a preemptive cut.
So the strong job market gave them cover to focus on inflation.
It indicated that one part of their dual mandate, maximum employment, was in a sufficiently good place, allowing them to remain laser-focused on the other, inflation, without feeling immediate pressure to loosen policy. It's that delicate balance where good employment data, paradoxically, reinforces the hawkish stance.
This decision also came against a pretty intense backdrop, with a lot of very public pressure from the White House, President Trump specifically, repeatedly calling for aggressive rate cuts. So how did this political pressure play into the Fed's actions, or perhaps Chair Powell's messaging that day? Was he trying to send the message?
That's a critical point, and it really underpins the Fed's long-term credibility. By holding firm and delivering such a consistently hawkish message in the face of very public and explicit political demands for cuts, Chair Powell sent an unambiguous signal.
To whom?
To the market, to politicians, to the world, really, that the central bank will not be swayed by political considerations.
Asserting independence.
Absolutely crucial. This assertion of institutional independence is vital for maintaining the Fed's long-term credibility in anchoring inflation expectations. That's a cornerstone of macroeconomic stability.
Right. If people think the Fed is political.
Exactly. If the market ever perceived the Fed as bowing to political pressure, it could fundamentally undermine their ability to control inflation down the line.
Okay.
So if we connect this to the bigger picture, the market's immediate negative short-term reaction on July 30th can be viewed, in a larger context, as the necessary price paid for reinforcing that vital institutional credibility.
Huh. So the short-term pain for markets strengthens the Fed long-term.
Potentially, yes. It was a tough message for investors to swallow in the short term, but one that perhaps strengthens the Fed's mandate and effectiveness in the long run. It was a demonstration of strength, even if it cost the market some immediate gains.
And the market definitely swallowed it, didn't it? The sheer hawkishness clearly caught traders off guard. How did that translate into immediate market fallout? Like right as Powell was speaking, describe the atmosphere.
Oh, the reaction was swift, dramatic, and decisive. It erased the day's earlier optimism almost instantaneously.
Wow.
Imagine the trading floors, initially buzzing with that good GDP news, and a sudden hush falls over as Powell begins speaking,
Yeah.
followed by a frantic flurry of activity. Selling. Equities, which had been trading comfortably in positive territory, turned sharply lower as Powell spoke. Quite literally reversing earlier gains within minutes, it was a textbook risk-off move.
And bonds, treasury yield.
Treasury yields, which move inversely to prices, they surged across the curve as investors rapidly repriced the odds of future rate cuts down to almost zero.
Okay.
The 10-year Treasury yield, a key benchmark for everything from mortgages to corporate debt, climbed significantly to 4.36%.
4.36.
While the 2-year Treasury yield, which is highly sensitive to near-term Fed policy expectations, jumped markedly from 3.86% to 3.93%.
That jump in the 2-year is really telling, isn't it?
It's very telling. It reflects a direct, immediate repricing of Fed policy expectations. And finally, the U.S. dollar index, the DXY, which measures the greenback against a basket of major currencies,
Right.
rallied sharply, gained over 0.8% to reach a 2-month high.
Why the dollar rally?
Driven by the clear prospect of U.S. interest rates remaining higher for longer. That increases the dollar's relative attractiveness to global investors looking for yield. It was a complete and almost violent reversal of market sentiment, all driven by a few carefully chosen words from the Fed chair.
Okay, let's shift gears a bit to that economic data itself. Segment 2. That headline GDP surprised the initial euphoria.
Right.
On the surface, that 3.0% GDP number sounded fantastic, a sign of robust recovery. But here's where it gets really interesting. That number, the Commerce Department's first estimate for Q2, seemed great. Beat forecasts, big reversal from Q1, looked like a full steam-ahead rebound. But what was hiding beneath that deceptively shiny surface?
It certainly did look fantastic. And it was quickly seized upon by some, including, as you mentioned, the White House, to amplify calls for rate cuts.
Right, see, economy strong, cut rates.
Exactly, suggesting the economy was too strong for restrictive policy. However, a deeper dive into the report's components painted a much more troubling picture.
Okay.
A conclusion echoed by numerous independent economists who cautioned strongly against taking that headline figure at face value. It was almost a mirage of economic health.
And the biggest culprit in this import illusion, as you've called it, what was driving that outsized number?
Exactly, the import illusion. The primary, arguably artificial driver of that outsized GDP print was a massive and highly volatile drop in imports.
Imports dropped. How does that boost GDP?
Well, this isn't a sign of domestic strength. It's more of a statistical quirk that inflated the number. Astonishingly, the decline in imports alone contributed more than 5 percentage points to the growth calculation.
5 points, just from imports.
It's from imports. Let's break that down. GDP calculations subtract imports because they represent foreign-produced goods. So when imports drop sharply, it artificially boosts the net export component of GDP.
Ah, okay, the math works out that way.
Right. But this particular drop was fundamentally not a sign of a strong domestic economy demanding fewer foreign goods. It was rather a statistical distortion.
So what caused the drop?
It was the direct consequence of companies having front-loaded their imports in the first quarter.
Ah, trying to get ahead of tariffs?
Exactly. Rushing to get ahead of anticipated tariffs.
Yeah.
This created an artificial slump in Q1 net exports, which was then followed by an equally artificial rebound in Q2 as that import activity kind of normalized.
Okay.
This is absolutely not a sustainable source of economic growth, and it significantly inflated the headline number, making the economy appear much healthier than it actually was.
It's like saying your house got bigger because you finally emptied out the garage.
Exactly. The space feels larger, but the fundamental structure hasn't expanded. Good analogy.
Beyond the import illusion, what other weaknesses were lurking in that GDP report? If we strip out that statistical noise, what did the actual domestic picture look like?
Well, we also saw a deeply concerning 15.6% annual rate of decline in private investment.
15.6% decline. That's huge.
It is. This isn't just a number. It's the steepest fall since the very beginning of the COVID-19 pandemic.
Wow. What does that tell us?
This sharp contraction reflects profound uncertainty among businesses and is largely attributed to the unpredictable trade and tariff environment we're seeing.
Tariffs again.
Yeah. Faced with potential supply chain disruptions, rising input costs due to tariffs, and an unclear future, companies are clearly postponing or canceling crucial capital expenditures.
Like on equipment, software, new buildings.
Exactly. This is a powerful signal of a lack of confidence in the future economic outlook. Businesses are essentially hitting the pause button on expansion and growth plans. That's a worrying sign.
And what about core demand, the real engine of the economy, consumer spending and business investment without those trade distortions? How did that perform?
Well, a more reliable measure of the economy's underlying health, one that strips out those volatile components like trade and government spending, is known as real final sales to domestic purchasers.
Okay, real final sales.
This figure showed a significant slowdown. It decelerated to just 1.2% in the second quarter, down from 1.9% in Q1.
1.2%. That's pretty slow.
It marked the weakest pace of underlying growth since late 2022. This figure provides a much clearer signal of the economy's true, decelerating momentum, unmasked from the statistical noise of the import illusion.
Right.
Even consumer spending, while showing a slight improvement, it grew at a 1.4% pace, up from Q1's 0.5%. It remains quite lackluster by historical standards.
So consumers aren't exactly splurging either.
No. It indicates that consumption, while not collapsing, is also clearly moderating and not acting as a powerful engine for broad-based growth. It suggests that households are becoming more cautious.
So we're talking about a cooling economy beneath the surface, but what about the labor market? It's been remarkably robust for a while, a real bright spot. Did that narrative hold up on July 30th?
The labor market data released during the day added to this kind of mixed picture. The July ADP employment report indicated a gain of 104,000 private sector jobs.
Okay, 104K.
Which, while stronger than the expectation of 76,000, is still a modest pace of hiring compared to the post-pandemic boom years.
Right, we were seeing much bigger numbers before.
Much bigger. This points to a clearly cooling labor market. Not collapsing, but definitely moderating. Many analysts have characterized the current state of the labor market as stagnant rather than dynamic.
Stagnant? How so?
Well, both the pace of hiring and the rate of layoffs remain quite low. People aren't getting hired rapidly, but they're not getting fired en masse either.
Okay.
The national unemployment rate has held remarkably steady within a narrow band of 4.0% to 4.2% for over a year now.
So stability, but not necessarily dynamism.
Exactly. While this stability is a positive sign, it means we're avoiding mass layoffs and widespread joblessness. It also lacks the dynamism and robust wage pressures typically associated with a strongly accelerating economy. So it's solid, yes, as Powell said, but not exactly surging or signaling rapid expansion. It's a job market that's stable, but maybe not thriving.
And then, almost paradoxically, within the very same GDP report that showed the import illusion and slowing investment, we got some news about easing inflationary pressures. This seems to directly contradict the Fed's hawkish stance. How does that fit in?
That's right. And this is where the picture gets even more complex for the Fed. The core personal consumption expenditures, or PCE, price index.
The Fed's favorite inflation gauge.
Their favorite, yes, because it strips out volatile food and energy prices. It rose at a 2.5% annual rate in the second quarter.
2.5%? Down
notably from the 3.5% pace seen in the first quarter.
Okay, that's a significant slowdown in inflation.
It is. And this easing of price pressures does indeed complicate the Fed's hawkish narrative, as it suggests maybe some of their efforts are working.
Right.
However, from the Fed's perspective, 2.5% is still not low enough to definitively trigger a policy shift. It remains stubbornly above their long-term 2% target.
Still above target.
Still above target. So while it's an improvement, it's not a victory in their eyes. And it forces them into a difficult position where the trend is good, but the absolute level isn't quite where they want it to be. It's a key tension point for them. This all raises an important question. Given this complex, almost contradictory data, why did the market's initial positive reaction to that seemingly strong 3.0% GDP figure turn so violently into selling? What was the mental shift for investors?
It's a classic case of what you've been describing, isn't it? The market realized the good news wasn't actually good news in the context of the Fed's priorities. They were looking at the wrong signals initially.
Precisely. The disconnect between that strong headline data and the weak underlying fundamentals created an incredibly challenging environment for investors.
Yeah.
The market's initial positive reaction to the 3.0% GDP figure gave way to aggressive selling after it became abundantly clear, especially during Powell's press conference, that the Fed was looking past that headline illusion.
Right.
And instead, they were focusing intently on the still elevated inflation and labor market's solid status. This sequence vividly demonstrates that investors are now processing strong economic news almost exclusively through the lens of its impact on Fed policy.
It's all about the Fed reaction now.
It really is. They've realized that a robust headline number actually gives the central bank justification to ignore underlying weakness and maintain its restrictive stance. And that, for equities, is a decidedly bearish development.
It's like finding out the extra weight you thought you lost was just the heavy jacket you took off.
Yes.
And the gym instructor, the Fed, is still telling you to run harder.
Exactly. The market, initially excited by the jacket coming off, quickly realized the real work hadn't even begun and the instructor wasn't letting up. That's a perfect analogy.
Okay, let's move to our third segment. As if the Fed's hawkishness and the confusing economic data weren't enough to shake things up, geopolitical risk added yet another significant layer of complexities July 30th, didn't it? It felt like a perfect storm of uncertainty brewing.
It absolutely did.
Yep.
Compounding the domestic economic uncertainty, the geopolitical landscape became significantly more fraught on July 30th as trade tensions escalated on multiple fronts.
Multiple fronts.
Yes. It created this sort of domino effect of anxiety. These developments placed substantial pressure on global supply chains, threatened corporate profitability, and, of course, further complicated the Federal Reserve's already complex policy calculus. It added a powerful new dimension of uncertainty that markets now had to contend with.
And a completely new front was opened in the trade war, this time with India. That feels like a surprising target given the current global dynamic.
That's correct, and it was indeed a significant and somewhat surprising move. President Trump announced a 25% tariff on imports from India.
25%. Why India?
Well, it wasn't just a random act. It was explicitly cited as being due to India's ongoing trade with Russia, particularly its substantial purchases of Russian oil, which the U.S. views as undermining sanctions.
Ah, the Russia angle.
Yes, and these new levies are scheduled to take effect remarkably quickly on August 1st. That gave businesses almost no time to prepare.
August 1st. Wow, that's fast.
Very fast. This action opens a new and contentious front in the global trade conflict, specifically targeting one of the world's largest and fastest-growing emerging market economies.
Yeah, India's huge.
The immediate market reaction was palpable in currency markets. The Indian rupee slumped to a 4-month low against the U.S. dollar on the news. Reflecting investor anxiety and the sudden repricing of this new geopolitical risk, it signals a broadening of the trade disputes beyond, the usual suspects like China.
And simultaneously, amidst this new India tariff front, the persistent U.S.-China impasse continues to loom large, not showing any signs of resolution, right?
Yes, unfortunately. 2 days of high-stakes trade negotiations between U.S. and Chinese officials in Stockholm concluded without any significant breakthrough.
No deal in Stockholm.
No deal. And critically, the talks failed to produce an agreement to extend the existing tariff truce, which is set to expire on August 12th.
August 12th. So another deadline looming.
Another deadline. This lack of resolution heightens market anxiety over the potential for a dramatic escalation in the trade war with China. We could easily see the resumption of steep retaliatory tariffs and further widespread disruption to global economic activity.
Yeah.
It leaves a very unsettling cloud hanging over global trade, putting businesses in a deeply precarious position as they try to plan for the coming months. It means the biggest trade war still has no end in sight, and potentially a new, hotter phase could be coming.
So if we look at the combined impact of all these trade policies, the new India tariffs, the stalled China talks, and existing barriers, what's the overall picture? It sounds like a deeply challenging environment for global growth and stability.
The cumulative effect of these and other trade policies enacted in 2025 is unfortunately creating a challenging stagflationary environment.
Stagflationary. Define that again quickly.
It's characterized by that unwelcome, difficult combination of slowing economic growth and rising inflation, both happening at the same time.
The worst of both worlds.
Pretty much. On the growth front, economic models project that the full suite of tariffs will act as a significant drag on U.S. economic expansion. One analysis estimates these tariffs will lower U.S. real GDP growth by a substantial zero point 0.5 percentage points in both 2025 and 2026.
0.5% lower growth each year.
Yeah. And what's even more concerning is the projection that this could lead to the loss of 500,000 payroll jobs by the end of 2025.
500,000 jobs potentially lost.
That's the estimate. Similarly, the OECD, the Organization for Economic Cooperation and Development, forecasts U.S. GDP growth slowing quite dramatically from 2.8% in 2024 to just 1.6% in 2025.
1.6%. That's a big slowdown.
Huge. And they attribute much of this slowdown to increased trade barriers and the profound policy uncertainty they generate. This isn't just about trade statistics. It's about real jobs and real economic output being potentially choked.
And on the other side of that stagflationary coin, inflation. How do these tariffs directly affect prices for consumers, even if they're implemented at a high level between countries?
Well, the tariffs directly raise costs for U.S. importers. When a tariff is imposed, it's essentially an extra tax on imported goods.
Right.
And those costs are almost invariably then passed on to consumers in the form of higher retail prices. That directly fuels inflation.
So we pay for it at the checkout.
Pretty much. The average effective tariff rate on U.S. imports has now reached its highest level since 1933.
1933. Wow, that's the Great Depression era.
Exactly. Back to the Smoot-Hawley Act timeframe. This is expected to push consumer price inflation higher, with the OECD projecting a year-end inflation rate of nearly 4%.
Nearly 4% inflation.
Yeah. And this isn't just theoretical. We're seeing real-world impacts. Companies like Adidas, for example, have explicitly stated that tariffs are directly hurting their business and may force them to raise prices for consumers, illustrating the tangible pocketbook impact these policies have on everyday goods. So you're looking at slower growth and higher prices, a very uncomfortable mix for the economy. And if we connect this back to the bigger picture, this tariff-driven environment places the Federal Reserve in an extremely difficult, if not impossible, policy position. They are truly walking a tightrope.
It sounds like a real policy paradox for them. They have these two conflicting mandates, inflation and employment, and tariffs just seem to twist them even tighter, pushing in opposite directions.
It absolutely is a dilemma. The tariffs are simultaneously inflationary because they raise import costs, which would strongly argue for higher interest rates to maintain price stability.
Right. Fight inflation.
But at the same time, they are a significant drag on economic growth because they disrupt supply chains, reduce business investment, increase uncertainty, all of which would conversely argue for lower interest rates to support employment and growth.
Fight the slowdown.
Exactly. Chair Powell's commentary made it abundantly clear that this profound uncertainty, this dual contradictory pressure, is a primary reason for the Fed's current cautious wait-and-see approach.
They're kind of stuck.
They are in a truly unenviable position, needing to balance two conflicting mandates, and these trade policies throw a massive wrench into their delicate calculations. It means every economic decision they make is now significantly more complex and fraught with potential for unintended consequences. And this leads us to the market's new reality. Investors are now being forced to price in a new, more persistent level of geopolitical risk premium. This isn't just a temporary blip. It feels like a structural change.
A structural shift. Okay.
Unlike past trade spats that were often viewed as temporary negotiating tactics, the current multi-front nature of these conflicts with India, China, the lack of resolution suggests a more permanent and structural shift in global trade policy.
So what does this geopolitical risk premium actually mean for investors and for companies? How does it change their approach day to day?
Well, it forces a fundamental repricing of risk across all asset classes. For corporations, it means they must now embed higher input costs, potential supply chain disruptions, and the uncertainty of market access into their long-term financial models.
So it affects their planning and investment.
Deeply. This is a key factor behind that observed plunge in private investment we discussed earlier. Why would you invest heavily in new equipment or facilities if your supply lines might be cut off or your market suddenly taxed out of reach?
Makes sense. You'd wait and see.
Exactly. This shifts capital allocation strategies. For the Fed, it means they must incorporate the structural uncertainty into its own economic models, making it less willing to provide clear forward guidance and, by necessity, more reactive to short-term data. They can't just assume trade tensions will magically disappear.
Right.
This entire dynamic increases overall market volatility. That sentiment is clearly reflected in the SIBO Volatility Index, or VIX, futures curve.
The VIX, the fear
The
gauge.
fear gauge, exactly, and its futures curve being in contango, which is a wonky term.
Yeah, what does that mean?
It simply means investors are expecting more volatility in the future than they see right now. It indicates that investors are actively pricing in higher volatility in the months ahead. Essentially, they're bracing for continued turbulence because this trade stuff isn't going away quickly.
Okay, final segment. Let's bring it all together. After all these conflicting forces, a hawkish Fed, deceptively strong economic data hiding weakness, escalating global trade tensions, how did all of this shake out in the actual market numbers at the close of July 30? What was the final scorecard for this chaotic day?
Well, the trading session on July 30th concluded with a clear and telling divergence among the major U.S. indices. This was a direct reflection of the day's conflicting economic signals and the market's significant recalibration of Fed policy expectations.
Okay.
The late-day sell-off utterly erased those early gains for the broader market, while the technology sector actually demonstrated notable resilience, which is an interesting point of difference and worth examining.
Let's break down the headline index performance. The S&P 500, the benchmark index for large-cap U.S. equities, really took a hit, didn't it? And it ended that significant streak.
It did. The S&P 500 fell 18.91 points, or 0.3%, to close at 6,370.86.
Down 0.3%.
And this marked its second consecutive daily loss and notably officially ended that remarkable six-day streak of closing at all-time highs.
Wow.
This isn't just a number. It signals a potential pause, at least in the powerful rally the market had been enjoying. It suggests the market, after weeks of climbing, has kind of hit a wall of reality. Investors were taking profits, and the enthusiasm that built those highs just evaporated.
And the Dow Jones Industrial Average, representing many of the more traditional industrial giants.
The 30-stock industrial average experienced the steepest decline among the major indices. It dropped 204.57 points, or 0.5%, to finish at 44,632.99.
Down 0.5%. Why steeper for the Dow?
This heavier fall suggests that some of the more traditional industrial sectors, those with deeper ties to global supply chains and trade policies, were particularly vulnerable to the day's news, especially those tariff escalations.
Right, the industrials.
These are the companies directly affected by rising import costs and slowing global trade.
But the NASDAQ Composite, the tech-heavy index, it bucked that negative trend. Why would tech be relatively immune on a day like this?
Yeah, in a clear sign of market divergence, the tech-heavy NASDAQ actually finished the session with a modest gain, approximately 0.1% to 0.2%, closing near 21,194 points.
So basically flat to slightly up.
Exactly.
Yeah.
And this outperformance occurred after the index had fallen 0.4% in the previous session, suggesting a quick bounce back for tech.
Why?
Well, the likely reason for this resilience is that many of the largest tech companies are perceived as less sensitive to immediate economic cross-currents or trade wars. They're often growth companies whose valuations are tied more to future earnings potential rather than current economic cycles. Or they benefit from a kind of flight to perceived safety within growth stocks when other sectors are under pressure.
Right. Less exposed, maybe.
Less direct exposure to manufacturing and international shipping. They often hold significant cash piles, making them more resilient during times of uncertainty.
And what about the smaller companies? The Russell 2000, which is often seen as a barometer for domestic economic health, how did they do?
The index of smaller companies, the Russell 2000, fell 0.6%. It closed at 2,242.96.
Down 0.6%, so worse than the Dow even.
Yes. This underperformance indicates that concerns about the domestic economy's health are weighing more heavily on smaller, more cyclically sensitive firms.
Okay.
These companies often rely more on domestic growth and local consumer spending than their larger, more diversified multinational counterparts. They're typically less able to absorb higher tariff costs or navigate complex global supply chain disruptions,
Right.
making them particularly vulnerable to the mixed economic signals and increased uncertainty. It's a sign that the pain isn't evenly distributed, and Main Street might feel it before Wall Street does, perhaps. And looking across the S&P 500's 11 sectors, the performance revealed a very clear risk-off rotation during the session. That's a key takeaway from the market's behavior that day.
So which sectors were the laggards? Where did investors explicitly pull their money out of, signaling their concerns?
The sectors most sensitive to economic cycles and trade policy bore the brunt of the selling pressure. That vividly illustrates that risk-off rotation. The industrial select sector SPDR, the XLI,
Right, the industrial company.
which includes companies involved in manufacturing, transportation, capital goods, was the worst performer, declining a significant 1.1%.
Down over 1%. Makes sense given the trade news.
Exactly. It makes perfect sense when you consider the impact of tariffs and slowing global trade on these businesses. It was followed closely by the communication services select sector.
Communication services, why them?
Well, despite including some tech giants, it also houses companies highly sensitive to advertising spending and consumer discretionary income, which would be impacted by economic slowdowns.
Oh, okay.
So this sector performance vividly illustrates the market's decisive shift away from economically sensitive assets, those most impacted by a slowing economy or persistent trade tensions, in favor of those perceived as more resilient or defensive. It highlights the underlying anxieties of investors on that pivotal day.
Okay, let's wrap this up. So, what does this all mean for you? For anyone trying to be well-informed in this increasingly complex world, what's the big picture takeaway from July 30, 2025, and how should we interpret similar events going forward?
Well, I think the big picture is the profound need to look beyond those headline numbers, to truly understand the underlying motivations and constraints of key players like the Federal Reserve,
Yeah.
and to recognize the deep, often surprising interconnectedness of global economics and geopolitics. July 30th demonstrated that the surface often hides a very different reality, and that what appears to be good news can, in fact, be a catalyst for market correction in a restrictive monetary policy environment. It teaches us to question assumptions and to always dig deeper, into the data and the context.
Indeed. Given everything we've unpacked today, the Fed's unyielding resolve to fight inflation, the hidden truths lurking within seemingly positive economic data, and the looming, escalating shadow of global trade wars, what aspect of these powerful cross-currents do you think will have the most surprising or perhaps overlooked impact on the economy over the next 6 months? What should we be watching most closely?
That's a great question, and it really raises an important point for all of us. In an environment where good news can be bad news, as we saw,
Right.
and geopolitical tensions are fundamentally reshaping global trade, how do long-term investors truly adapt their strategies beyond just reacting to the daily headlines?
Yeah.
And perhaps more critically, what unforeseen consequences might arise from central banks having to prioritize inflation over growth, potentially for an extended period, especially when facing these kinds of tariff-induced conflicting pressures we discussed. The delicate balance they must strike is becoming increasingly difficult, and its fallout could ripple far wider than we currently anticipate.
A lot to think about there. Thank you for joining us on this deep dive into a truly pivotal day for the markets. We hope you feel much more informed about the intricate forces at play.
Yeah, critical thinking is essential in a world of information overload, and we encourage you to continue dissecting the data, trying to find the true signals amidst all the noise. Keep exploring.